What's up everybody, I am Jaspreet Singh and it looks like the used car bubble and the auto loan bubble is starting to burst. Here's the thing, gas prices are still extremely high. Couple that with inflation breaking new record highs and now Americans are starting to struggle on their car payments. It's been a really weird couple of years for the car market because when the economy got shut down because of the pandemic, there was this huge chip shortage which caused a supply shortage of cars. And the supply shortage of cars caused the price of used cars to skyrocket, and your used car now became an asset. You could literally go out and buy almost any car and drive it around for a year and then sell the car for a profit. That's not normal. Well, now it looks like this bubble is starting to lose steam because Barron's released an article titled "Car Repos Are Exploding," and then my friend Marco at Whiteboard Finance also released a super in-depth video about what's going on with car repos. It's a great video, so if you want to watch that, I'll also link it for you down in the description below. The whole idea is that car repossessions are a major recession indicator because when the economy is slowing down, people start to struggle making their car payments. Because now if inflation is so high and you can't afford gas, you can't afford the higher groceries and your rent, well, if you stop making a car payment, then the repo man's gonna come and they're gonna take your car away from you. And what we've been seeing lately is car repossessions have been going through the roof. That Barron's article that I showed you earlier talks about a guy named Lucky Lopez who's a car dealer and he buys these repossessed cars before they hit the auction. And let me just read you one paragraph from the article. Part of the problem is that some consumers' incomes were temporarily high as the pandemic brought about debt forbearance, pandemic stimulus checks, enhanced unemployment benefits, and in some cases forgiven loans from the Paycheck Protection Program, aka PPP. In other words, people felt wealthier than ever during the pandemic in the middle of a recession because nobody had expenses because the economy was shut down, and on top of that, people were getting free money from the government in the form of stimulus checks, in the form of unemployment benefits, and you also had debt forbearance. So people weren't paying their mortgages, some people weren't paying their rent, and so you weren't paying for your debt payments. Well, you had more money coming in from the government, so people were going out and buying nice cars because they felt like this new income, this new wealth that they had wouldn't go away. And I'm not just talking about Toyota Corollas and Camrys and Ford Focuses, I'm talking about some nice cars. He talks about how he also bought a Bentley, a McLaren, and 2 Aston Martins. All of them were purchased by buyers using PPP loans as down payments. And then he came in and he bought these cars out of repossession because the owners were not making the monthly payments. And he's talking about just months after people bought these brand new nice cars, he came in and bought them out of repo. By the way, the PPP program also contributed to one of the biggest financial frauds in the history of America because now you had so many people, including people who are not business owners, trying to take advantage of these business loans because people started filing these fake businesses or said they were the owner of these fake businesses and they were just doing this to steal money from the government. This is one of the reasons why I kept saying that I refused to take a PPP loan because I didn't want to contribute to the higher inflation because I knew where the money was coming from. But that's just one of the things that happened with the pandemic. But according to this article, the second factor that contributed to this auto loan bubble were banks. It says that banks' auto lending standards went out the window and then lenders jumped on the bandwagon of overpaying for cars. Everybody thought the free gravy train would never end. So to paint a whole picture, first, people had no expenses. The government said you didn't have to pay a rent, you didn't have to pay a mortgage, and on top of that, people were stuck in their homes, so people were not spending money. Second, on the income side, people were rich because the government and the Fed were sending out money like it was printed on trees, and so the government and the Fed are sending out money to people in the form of stimulus checks and unemployment checks, and they're giving out money to small businesses in the form of PPP. And then on the third factor, you have the auto lending industry, which is now so loose and all standards went out the window, so anybody could buy a car. And so you could just show, hey, I made all this money from the free pandemic money and I can go and get qualified for a very nice and expensive car. What he said was kind of scary. He said that he's never seen so many people earning $2,500 a month with a $1,000 a month car payment. Who needs groceries when you got a nice car? Although I can't afford my gas anymore. Wall Street Journal actually talked about this. They said that in June of 2022, a record 12.7% of new car buyers bought a car now with a $1,000 a month car payment or more. Car prices have been booming along with higher interest rates, and it goes back to supply and demand. On one hand, we had a super low supply of new cars because you had the chip shortage. Companies could not create more cars. So you had a limited supply of cars while the demand for cars shot up through the roof because people felt rich. They didn't have expenses. They were getting free money from the government. And then it was very easy to qualify to go out and buy a new car. So everybody wanted to show off their new pandemic wealth, their new recession wealth by buying a brand new car or by buying a new or used car, whatever. They're buying a nice car. And so demand shot up, and this recipe shot the prices of cars through the roof. Now, in today's economy, we have high car prices, and now interest rates are also going up because the Fed is trying to fight off this high inflation because of all the money printing that happened in 2020 and 2021. And now with these higher interest rates, just like with the housing market, you have to pay more money per month to finance a car, not just because you're financing more dollars, but because you're paying a higher interest rate to finance the more dollars that you're borrowing. But what we're starting to see happen now is it's starting to flip because the demand for these cars is starting to go down because people can't just afford these higher priced cars. And in addition to that, they can't afford these higher payments on cars because of the higher interest rates. And supply is starting to grow because we're starting to see more repossessions, some more cars are being built. So we're starting to see this flip, and this is causing the price of some cars to go down. And this is why the article talks about how so many people are now underwater on their cars. One of the reasons is because we're seeing the price of some cars go down. So you bought a car for $50,000, you financed it, and now the car's only worth $45,000. But the second part of that is the amount of lending that was being done on cars, which is kind of scary because you had all these lenders that were not lending 80% loan to value, which is typically what happens, meaning you go out and buy a $50,000 car and the bank lends you $40,000. Instead, what was happening is people were getting 140% LTV loans, 140 LTV, which means you go out and buy a $50,000 car. It's worth $50,000 today, or at least that's what the sticker price says. So you enter into a contract to buy a $50,000 car, and the bank says, we're not going to give you $50,000 or $40,000. We're going to give you $50,000 plus some closing fees and some extra fees because why not? You'll take the money. And so now the bank is giving you 60 grand, maybe even 70 grand for a $50,000 car. And now you have so many people that are underwater on these cars that these repo people are saying, holy moly, we can't keep up with all this repo demand. By the way, my team did cover this entire story in Market Briefs, which is my free financial newsletter, which is why if you haven't subscribed to Market Briefs yet, I highly recommend you do that because my team is breaking down what's happening in the real estate market, the crypto market, the stock market, inflation, the economy, general economy, and the global economy. And it's a completely free newsletter. It's fun to read, it's easy to read, it's witty, it's funny. I mean, there's none of that complex financial jargon, and it's completely free. So if you haven't joined Market Briefs yet, make sure you do that. I'll put the link to how you can join Market Briefs down in the description below. But if you take this one step further, this is where things get really interesting because what Mr. Lopez says is that yes, banks were giving out 140 LTV loans, meaning $70,000 for a $50,000 car. But what's happening is now he's coming in and buying these cars at auction, not at 140 LTV, but at 70 LTV. So he's buying them for 50 cents on the dollar, or at least 50 cents for what banks paid, meaning the lenders, the banks in these instances, are losing half of their investment when a car gets repossessed. So now if we zoom out from the auto market a little bit and we look at this more bigger picture, what does this mean? We have inflation, which is still growing. We have inflation at record highs. We have an economy that's slowing down. Companies are struggling, keeping up with the higher costs. Companies are struggling, keeping up with the slower economy. They're doing hiring freezes. They're laying people off. So you have the cost of living going up. People that are losing their jobs and people that are now struggling more financially because they can't keep up with their higher cost of living. They can't keep up with the lifestyle that they had during the pandemic. We've already seen credit card debt skyrocket in 2022 because people wanted to keep the same lifestyle that they had in 2021. And now the first place where we're really starting to see the impact of this is in the auto market because people who bought these really nice and expensive cars are saying, I can't keep up with this car anymore, just take it away. And so we're starting to see repossessions skyrocket, which means that if this continues, then we could start to see more credit card debt defaults, we could see more personal bankruptcies, more defaults, and that could lead to more financial dominoes because now if banks and lenders start to struggle because they're now losing money on all these cars, then you can see more layoffs in the financial sector. And if people get laid off and they don't have the ability to make their car payment anymore, how much longer until they can't make their housing payment or their rent payment? So that could lead to more evictions and more foreclosures. And you can start to see how the economy is all tied in together because it's one domino after the other. When the economy starts to slow down and it shrinks, people lose their jobs, you can't make a car payment, you can't make a housing payment. And then that then hurts the next layer because banks start to lose money. Then banks have to let people go. And you see more foreclosures, you see more layoffs. And this is where typically the Federal Reserve Bank would come in and they would start stimulating an economy. They start cutting interest rates. They start doing quantitative easing. They start doing stimulus. However, they don't have the ability or the same ability to do that right now because we're facing record high inflation. That stimulus, the quantitative easing, the cutting interest rates that the Fed typically does when we're in a recession or when we're in a slowing economy, those things cause more inflation. They're all inflationary tactics to cause the economy to boom. However, when you're in a time where we're already in a high inflationary economy, how are you going to stimulate the economy with more inflation when the inflation caused the economy in the first place? You cannot fix an inflation-induced recession by causing more inflation. So this is causing a big conundrum. And we've been talking about this for a year now, or more than a year, but we've been talking about how the money printing has costs, how the inflation is going to get worse, how this inflation problem is going to be around for a while, and how it's going to affect the economy. And if you keep listening to just what the Fed and the government say, that everything is fine, the economy is fine, there's no inflation issue, well, then you're the one that's paying the price. And this is where you have to get smart and pay attention to what's happening. Obviously, we talk about this in Market Briefs, my free financial newsletter, which is why if you haven't subscribed yet, make sure you do that. But we also have to understand now how you can take advantage of the situation. Because the reality is either you can sit there and watch it happen, you can be one of the people that are burned by it, or you can be one of the people that take advantage of the situation. That means take advantage of opportunities that come your way, meaning when you see investment opportunities that happen, because when you see these types of economic downturns, when you see these types of market downturns, when you see this type of volatility, it creates a lot of panic, it creates fear, people get scared, they sell out of their assets, they sell out of good assets because they're worried or because they need the cash. Well, this can create opportunity for you to come in and find and purchase good assets at a discounted price, but it requires you to be prepared and it requires you to be educated. You need to be prepared, meaning you need to have the cash. So that means putting in the work when times are good. And that means also being educated, being aware that, hey, this is a good time to take advantage of these opportunities. This is a good time to buy. And that means knowing what to buy, putting in the time and research to learn how to invest your money, learning what an asset is, learning what a liability is, learning how to find a good asset, knowing what it is that you want to invest in. That will, when these opportunities arise, you can come in and take advantage of them. You have to have a long-term mindset if you want to succeed in the stock market or any asset class, because over the long term, the people that make the most money are investors who invest for the long term, not just short-term traders. And so you have to have that financial focus and not get carried away by the day-to-day swings.